So we have two new faces. We have Bill Weil, William Weil, but many people call you Bill, including me. Learning by doing. Ludgate, you are a really late-stage VC. And Gerard, he's a famous guy and a smart guy from Alexa Capital. You used to be the head of research at Jefferies in the past. And now you are an entrepreneur, and you are writing a great blog. It's called Energy and Carbon.
Yeah, that's true.
Who is reading it? Raise a hand.
You're not reading it, are you? Yeah, of course.
Okay, look,
that's
you have
great.
a couple of readers here on the panel.
Wow.
And we have Martin back and Felix back, and we want to talk about late-stage investing. And I think we start by defining late-stage, yeah, and even finding out if it is a good term, if you are using it on in your daily work.
Yes.
How do you define late-stage?
The short answer is yes, we do use it. Obviously, like most of these kind of vague terms, it's doesn't have formal boundaries up and down. But typically, what we would say is we're well past the seed and venture stages where you're proving out the technology or proving out the business models, where you've already got material revenues in hand. Some people, I think the real question of where a late stage starts is around the EBITDA positive zone. And that, I think, is the kind of company that we typically look for when you've crossed that border and you're looking for, as described, expansion capital. That's really where we come in.
Why are you a late stage investor and not an early stage investor?
Why is a ladybug not a bird? There's space for everyone. I think the point is we found that this is the area of the value chain that we think we can add value and really deliver something both to the companies that we work with and to our investors. And I think that's what we've carved out, and we see where there's an appropriate risk and return balance. I think if there were no earlier stage investors, we'd have no companies to invest in. So I think it's all needed, of course.
Can you give us a transaction example? I think you have been an investor in Lumicity.
Yes. Yeah.
You recently sold it.
Yes.
When did you enter? What was the size of the company? When did you exit? What was the size at exit? And how did you create value on top of the money during your holding period?
You should always ask the CEOs. It's unfair to brag about yourself. Lumicity. So maybe it's good if I step back very quickly and tell a bit about the types of investments we do, because Lumicity is one particular kind that needs a bit of explaining. So Ludgate invests across what it used to be called clean tech, green, sustainability, resource efficiency, whatever the nom de jour is. For us, one of the areas of that is renewable energy developers. And within the value chain of renewable energy, we found a particular home within development companies. So we invest in the top co of a company which is developing a renewable energy, typically one of the large ones, so either biogas, biomass, wind, or solar. And we invest topco development equity, as well as then a good portion of our money going down to the assets. Lumicity was an investment of ours in 2011, I believe. We recently exited it for a reasonable multiple on our initial investment, despite having several near-death experiences, given that we were developing in the UK, and the sort of on-off trajectory of development here in the UK has been challenging, to say the least. I think, if you'll forgive me for just one more moment.
Please go ahead.
I can give another example from another segment, which kind of maybe is more emblematic. A company called RAP, Rapid Action Packaging, which is an environmentally friendly packaging company, slightly off the beaten track if you think about sort of the typical segments in investment areas under that umbrella. We invested in 2008 initially. We're still in it, but it has grown significantly. And why I wanted to mention it is the interesting thing there is we invested when it was turning over something around 10 million. It's now well over 20. We invested specifically in capital expenditure to build a second production line for that company, which not only doubled capacity, but also allowed it to supply just-in-time customers who wouldn't wish to be exposed to single machine failures. So if they had only one machine, they would limit their exposure to that company by supplying only, say, 30 or 40%. With dual machines, you can say to the customers, look, we have backup, and that allows them to take a much larger portion of their total custom. Investment size, we started out with about a £5 million investment. Over time, that grew up to about 9 million. And it's interesting, actually, just to quickly mention, it was in several structures. And I think this is an important part of the story. We invested not only in equity, also in convertible loans and full loans to the company to support different elements of their growth over time.
Gerard, you are helping startups fundraise, mainly from late-stage investors. How is it going?
Good. Very well. Very well.
Can you explain a little bit what you are doing more specifically? Maybe give us an example and maybe describe a little bit the investors that you have access to.
Right. So maybe I take a step back and tell you a little bit about who my business is. Alexa Capital has 3 partners, myself, Bruce Huber, and James Adams. We all come from different worlds. I come from Ireland, one's American, and one is British. We also have completely different backgrounds in the sense that one's an investment banker, I'm a research analyst, and the other one is an infrastructure guy. And we've all been working in global energy for the last decade, and I suppose that's probably what at the end of the day makes us unique, is this collection of relationships and I would say industry knowledge that we have, and I'd like to say that makes us quite special. And I give you an example of what we're doing at present. I'm doing work in the battery space at present. I'm doing a 60 million capital increase at present. It's a European business, but we made a very clear decision at the beginning that we'd have no European investor in it. And the reason is because we don't believe that there is anybody in the European network or landscape that can really help this business do the land grab that we think it can do globally.
Not enough capital in Europe?
It's not about capital. There's money everywhere. There's money everywhere. It's not about money. It's about who's the right partner to allow that company to be what it wants to be, which is the #1 in its space globally. And just happens
and there are no strong partners in Europe?
No, absolutely not. And
wow,
this was
that's bad luck for Europe, isn't it?
And by the way, this is very important. So you ask me what differentiates us. Is that what's very important, I would say this to any entrepreneur, it's easy to get money, but it's not easy to get the right money. It's the same as you don't marry the first girl that you meet. I would say to any entrepreneur, don't take the first money that comes your way. Really decide what is it that I want and see, does the money fit? So in the case of this particular business that I'm talking about, we believe that the European money that's there doesn't fit this business. It will not enable it to go to the next level. So we've looked at Asia and America for money. But that's not the case all the time, you know. But that's certainly what we do. This strategic aspect is very, very important because the energy world we're in, Felix has said it a few minutes ago, it's in huge change. I think our oil industry is going to go through change. Our utilities are already being changed. And these technologies make it very, very difficult for investors or for industrials or strategic people to invest. And I suppose we're in the middle of that. That's the best way to describe it.
Wow.
You do know you're sitting between 2 investors.
I know.
I
know.
We'll let you get away with it for now.
I know.
Are we going to take that outside?
You want to play rugby with an Irish? Are you sure? You are from UK, right?
US.
He's American.
You're American. Okay.
Well, apparently the Asians are not too bad at that, as we recently learned.
But by the way, these guys are institutional investors. So I was talking about strategic investors, right?
Yeah.
And strategic investors are global. And if you want to build a global business and be #1, then get the right investors in.
So basically, global corporates?
Global corporates, absolutely.
Yeah, not coming from Europe.
And by the way, I would say sometimes global institutional investors, because if I compare the US to here, if I'm a capital-intensive business, I'm getting my money in the US, I'm not getting it in Europe, because the appetite among clean tech investors to go into capital-intensive investors is not there. It's just not there. And they're scared about it because they've made mistakes in solar, and they're afraid they'll make mistakes, particularly in battery. And if I look at the battery space, I find it very interesting because there's not one lithium-ion manufacturer in Europe. Let's be honest. It's in China, it's in Korea, it's in Japan, and maybe a little bit in the United States. Okay, because their investors and the strategics say, it's important, we're going to put the money in. The Europeans go, oh, I'm afraid to do that, I'm not going to do it. And I think that's
So basically, you know pretty well who you are looking for that startup.
Absolutely, of course.
And it's basically a big strategic battery corporate. And because there is no big strategic battery corporate in Europe, that's actually the reason why you look for them outside.
There's a few pretenders like Bosch and people like this, but I mean...
I think Robert Bosch guy, Heribert is still here. He will probably play rugby with you afterwards too.
Wait a second, let's talk about the electric car, because be very clear, let's be clear, because they're in big trouble. The reason they're in big trouble is because Daimler is going to make its own battery packs. The cells are going to come from South Korea. So what's Bosch going to do? Bosch is out of the major component in the future of the electric car. That's a disaster for the business, okay? That's what I say, a disaster.
Yeah.
It's a tough job, you're right. It is a tough job, okay? And they tried to go to bed with Samsung, and that didn't work out.
Yeah. No, but this is an interesting example of really finding out, Jan, who is the company that you want to have as a new investor? Who is the player that can really, really add value for you, right? I think you are in a similar situation. You have a similar hope to find this perfect match. How do you go about finding the strategic magic?
It's very interesting to sort of see how times change over the lifetime of a business. I remember when I first started at Grundgrün, I think we had about 3 million revenue. We had 15, 20 people, and I would talk to private individuals. I would talk to all sorts of investors and businesses and angels and people to kind of get a feeling for the market. And that was good back then, because that was what I needed was money, maybe a little bit smart, but mostly money to grow the business. And now when I go out, I very much look at the larger picture, like I tried to mention just before. What we really want to do is not just have money to build something and to do something, but we want to really disrupt the market. And to be able to do that, you need to be very careful who you go to bed with, as Gerard put it very, very delicately. But you sort of have to think about who has what incentive. And I think that's the major part. I mean, the institutional guys who are at the panel here, they're great partners, and they're people that's probably amazing to work with. But their incentive is a purely financial one. And yesterday somebody said it's great to have them at the table, and I personally like that, because to challenge a CEO to deliver pure financial performance and to create value, I think is great for business as such. But if you then sort of take the next step, or maybe the step afterwards, you might need something else where you think about how can I really make the whole market change. And for that, at least in Europe, there's not a sort of institutional investor market that is so established, at least from my, I mean, there's some guys like Generation Investment with sort of huge amounts of capital that they can allocate, but there's not that much of a culture as it is in the States. So to look at strategics is definitely an option that you can do when you go in later stage. But I would always recommend to map that against institutional investors as well. So never go just one way. Always sort of look at the market as a whole and sort of see what each party can bring you. And then it has a lot to do with your market, because with some products it might be better to remain totally independent and to just have institutionals in. With other products, you might need somebody from a totally different space who wants to enter your market, or you might even talk to an incumbent if that is what you want to do. I'm not sure if that's what people should do, but so it depends who you go to bed with, and you have to really think about the problems they're having.
You are basically an asset-light or almost no asset smart green utility, where you are marketing renewable energy to the people who want to buy it.
Yes.
Yeah. And who would be a strategic that you think would fit well?
I mean,
if you don't want to call out a name of a company, but give us some ideas about the industry and what would be perfect for you.
I think what we are when we look at these kind of ideas, we want to look for a certain sort of number of parameters that are important to meet, and one would be low cost of capital, because yes, we're asset light, So we don't want to buy power plants and stuff, but we are a business with incredibly high turnovers. I mean, this number looks great when I say we're going to have sort of 150 plus revenues this year, but a lot of these revenues are from buying and selling power. It's not that somebody, people actually buy my power, so it's proper revenues, but it's still, it needs to be done in certain systems. So I need trading partners, I need collateral, I need initial margins to be posted. At the moment, we only trade in very few selected European markets. If we want to trade properly pan-Europeanly, we probably need about 80 million of initial margin investments to just open up these markets to us. If we want to trade with other counterparties, we need to post collateral for that, for OTC trades. If we want to go into the large-scale energy delivery business even more, which we're doing at the moment, we suddenly have contracts with corporates who buy our power, and they pay us about 15 million a month for just one single factory or something. And then I need to think about how do I manage that risk? What happens if they go broke? So I basically need working capital, really. And I can't deliver the 17, 18, 90% that those guys would have on that, because it's a low-margin business, or energy utilities. So then I'd have to look for cost of capital. So that's the one thing. And then the other sort of parameter that you want to look at is their own strategic goals and their problems. So if you would, for example, look at the big 4 utilities in Germany, if you talk to them, probably they might be quite interested in working with a company like ours, but you would then be in the business of maybe correcting their mistakes of the past. Is that really something you want to do? It might be interesting, because you might team up with the right one to then really change the market. Or you might want to talk to somebody who comes from a totally different, maybe telecom, maybe somebody who's used to network products, who wants to just add energy as a quadruple play solutions. Or you might want to talk to somebody in Asia or in the US who sort of sees Europe as a market they want to get into and really want to invest into that, because their appetite is different. So it's a pretty vast spectrum of things that you have to talk to, and that's why we do that as well. I mean, we have a quite international network of talking to different parties that we're excited to work with, or maybe even partner up with.
Yeah. Martin, how do you define yourself at MVP, Munich Venture Partners? Are you rather an early stage investor, or rather a late stage, or even both at the same time?
I would say both, but it depends on your perspective. I was recently attending a meeting with a lot of private equity people. I think from their perspective, we are early stage, maybe even underground. But let's say in the VC world, I think we do both. We have done some seed investments, even founded some companies. If you would ask me today, since our fund is now in the 4th year, we would look for more mature companies, and from a VC perspective, maybe mid or late stage. I think, like you said before, break even visible at the horizon would be good. So yes, we do both. Right now, mid or late stage VC.
You have a couple of companies. I think you mentioned 15 companies in your portfolio. Yeah. How many of them have more than 10 million revenue?
3.
3?
Yeah.
And these 3 companies, do they still need more capital?
Yeah, they do. One, of course, is Sonnenbatterie. So, and all of them are above 20 million now. So
Keboni?
Keboni and As Good As New.
As Good As New.
Yeah. And As Good As New just closed a round with us, so I think they're well financed, but they will look for more money in the future. For Sonnenbatterie, we have the investment of Inven, which was, I think, for all parties a good deal. And for Keboni, we are in fundraising right now. Hope we can disclose who will be the new investor in, let's say, a month from now. Term sheet is signed, so, and yes, they are looking for more money.
And do you know these 3 companies, Bill?
Yes. 2, actually, only 2 of the 3. So.
Sonnenbatterie, Keboni.
Yes.
Yeah.
As Good As New, it's a German company.
It's a rebuy competitor.
Okay.
So refurbishment of electronic goods.
Yeah.
Yeah. Would Sonnenbatterie and Keboni be interesting for your investment strategy? Let's try to barter a deal here. So this panel is productive. I get a commission.
I think he's already one step ahead of you. I mean, I think generally speaking, yes. I mean, those are the kind of companies that are certainly would couch as later stage, growth stage companies.
But to be honest, I think it's not that easy to get capital out there, especially in that phase, because you're too slow for private equity, too small for private equity companies, already too large and too expensive for the conventional VC investor. Yeah. So there are people out there, but you need to convince them and work with them and educate them, and maybe they're looking at the deal for more than a few months, rather a few years before they invest. So, and I completely agree. Capital availability in Europe is too small.
So basically, at a certain moment of time, when you are not longer a small startup and you are rather a big startup, but you even want to be a very big startup, you need, if you are in a capital-intensive business, a lot of capital, and then you hit a moment where it's hard to find the capital in Europe, and you basically have to search all over the planet, right? And these big rounds, these big relationships, they also take a lot of time to build, right? So I think if you are working for a client, you don't do the job in a month.
No.
It's a really long process.
If it takes 6 months to get, actually, a very simple thing. If I want to get these guys to a meeting, to a company, I'll probably get it done in 2 weeks, right? I'd probably say, listen, guys, great company, come and have a visit. If I go and try and get Mitsubishi in Japan, they're laughing, right? 3 months if you're lucky. So you really have
the first meeting.
to take the first meeting. Yeah. So it really does.
But then they come with 10 to 15 or 20 people into the first meeting, and they are well prepared. That's the Japanese way.
And then the second meeting is 20, and then 25. But you really have to double. If you're going to get strategics in, you really have to double the length of time that you think it will take to actually get the capital in. And that's European strategics. So if you're taking foreign, outside Europe, strategics going to take even longer.
I'll just, because I have to, I'll make the pitch for institutional versus strategic. There's also the element which we haven't really broached, which is particularly interesting for you, is depending on the strategic that you take on, you're also limiting your exit options, which I think is a big consideration, or should be a big consideration for the company.
And so that's the job of the advisor, to make sure that actually the strategics, especially if you get more than one strategic in, that firstly they get on with each other, and secondly that the synergies, and thirdly that you can get a clean exit, because that's very, very important.
Restrictions on exit are.
So in your case, are you looking for one strategic, or could it be rather a syndicate of several strategics?
I have a syndicate, and the reason we have a syndicate is because we believe there's a land grab that's needed in the battery space, and that requires maybe a solar company, that requires maybe a cell manufacturer, that requires maybe a renewable developer, and in different regions. It's a very clear strategy. The company has a strategy. We need to map and match the money to that strategy. I think that's very, very important.
And if you are trying to close such a big deal, you are always you always have the option of an exit too, right? Some of these strategics are coming to you not only talking about minority investments, but rather purchasing the whole thing. How do you convince them that this is not a majority offer here, not yet?
Well, because actually what you have to do is convince the existing shareholder that they shouldn't be exiting, because it's up to them at the end of the day. I mean, if somebody comes to Sun and Battery and says, we want to buy it, I have to convince him that you should be staying for a period of time. So that means you have to really talk about the opportunity that that company has and the possible exits in 2 years' time or 3 years. And that's what we do. And by the way, sometimes it does make sense if Bosch comes into Sun and Battery and says, we don't want to invest, we want to buy it. Then you maybe do sell it, So, but I want to come back to one thing I want to say is about Tesla, is I do not believe Tesla would ever have taken place if it would have been a European company. And that's very sad for us as a continent. And don't forget, he's a South African who's running the company. And I go back to what was said 5 years ago. BMW said 5 years, they'll never be able to do anything. My God, forget about it. The quality, no, they'll never be able to do it. I laugh at BMW now because if you see the console in a Tesla and compare it to the BMW, my BMW has a console that's like an Atari console from the 1990s, and the Tesla has got a touchscreen, all right? And that's a revolution. And by the way, they're also revolutioning the battery space. And I suppose I say to the entrepreneurs here, be brave, guys. We need brave entrepreneurs in Europe that feel they're actually going to take on the world and take it over. And by the way, don't forget, Daimler came in and put money into Tesla. So, the Europeans will put the money in, but think big. That's what I would just say. Think big. This is a revolution we're in, and we need good entrepreneurs.
But there was also a German and a Brit at the start of Tesla.
You're absolutely right.
So
You're absolutely right.
You're absolutely right. You're absolutely right. They just happened to.
They happen to be on the States.
To Silicon Valley to do it.
No, but that's actually very, very good what you say there about thinking big. That what I see in Europe with a lot of, I obviously have a lot of friends who are CEOs of startups, and talk a lot to institutional investors and things. There's too much thinking in Europe about sort of a small scale exit to somebody instead of really building something big, and so really revolutionizing the world, really having a like an Uber or sort of like a really Facebook-like disruption on how the world works. And that is just something that I feel there's sometimes not enough institutional investors in Europe who have that risk appetite to really do that, to not just commit 50 million, but to commit 500 million to something. There's just not really enough. I know that's more the private equity stage of business, but that should probably exist in a bit of an earlier stage, because the world is moving so much faster now than it used to only 5 years ago, that if we don't do that, the continent really will not keep pace with what's happening in the US and what's starting to happen in Asia.
But I think one of the problems is that we don't have too many role models for huge exits here, and without those role models, you don't find the risk capital for it. And the whole ecosystem is not yet there like in the US. And so I think investors have to balance the expectations between, okay, we are VC and we're looking for unicorns, and on the other hand, bring back at least some returns. So that's, I think we need to work hard on the whole ecosystem, and Jan is doing the best job there.
I mean, fundamentally, you don't actually have money. I don't actually have money. We're middlemen between entrepreneurs and our LPs, our limited partners, who actually have the money. And to a very real extent, we are shaped by what our LPs give us money to do. And at the very start of the kind of clean tech bubble in the European market, it was led by the two big gorilla exits, which was Rake and Q-Cells. And the stumbles that they have had subsequently scared a lot of the LPs who we go and fundraise from. And so I think that's a very real concern, and those are tangible markers for them, and there are not so many big exits other.
But that's a very good example. So let's go back to Q-Cells and REC. They were family offices. They were not institutions, they were not strategics, they were family offices that believed solar would revolutionize the world, and they were going to push it.
That's right.
Right? And that is also the other thing that's needed in Europe. It's back to leadership. Is that, institutionals, family office need to lead and say that's what we're going to do. And we don't have that at present. Those two family offices they're not really actively investing anymore because they lost money in the space, right?
Who were the families about?
Well, I mean, Stroher family, Welle, as in, the hair product company. They were in Solon and Q-Cells. And then you had the Brigsmar family, which is CNA, which is Good Energies. I mean, they made money and then they lost a lot of money, but we don't have that type of investor anymore. The good news, though, is there's strategics. The utilities, for example, are all setting up VCs. Bosches, the BMWs of this world are becoming much more active in terms of money. So there is other capital getting there, but it's slightly different than that family office capital. The family office capital really, they were able to throw loads of money at stuff and say, okay, go with it. The strategics have strategic angles. That's why they're investing. And that sometimes can hem a company.
Family offices, it's an important term, I hear it very often, but they're very hard to find. These big families, they're hiding quite well. Although they're big, they're very good at keeping a low profile. But as a matter of fact, I find it a little bit contradictory. Some of the families, they really want to do good. They want to become an impact investor. They want to support clean technology companies, but they are hiding. And the clean technology companies that would really like to work with visionary family offices, have a hard time to find these family offices.
I have to say they show up. I think in, let's say, a third of our portfolio companies, we have family offices directly invested. And sometimes even after we invested, which was, 10 years ago, maybe a showstopper to have family offices after the VC invested. But since there are not so many VCs anymore out there for that kind of investments, we see family businesses investing directly more and more and adding value, because those guys are usually successful entrepreneurs contributing to the business too. And with the network.
And you're seeing the Quant family, which is BMW. I mean, they're in wind, they're in solar, they're in storage, they're in carbon, they're in water. I mean, you know, Wacker, the same thing. If I look at Wacker Chemie, Wacker Family, same thing. There's a lot of these family offices doing a huge amount, but they don't want to be out there on the front page of the Financial Times.
For example, Heliatech, yeah. I mean, I have the feeling that they also need 50 million, yeah, because they would love to build a big factory, but they really have hard time for many years to find this amount of capital. And just to give them more lifetime, yeah, a family office has stepped in, Stefan Quandt.
Exactly.
Into
That's what I'm saying, the
Heliatech.
Quant, exactly.
Yeah. Yeah. Okay, so I think this panel is coming to its end. I want to thank 4 smart guys, and we just do one more thing, which is a presentation of my special friend Pedro Miranda, and then we hit the bar, okay? Excellent. And you guys help me. You guys a little bit early, I know, but it's Ecosummit style, so you're already used to it. We take our bar stools out, okay?
Excellent.
Thank you.
Thank you very much.
Thank you. Super. Great.